Good evening, everyone. Welcome to our UC Riverside Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thank you so much for taking time out of your busy schedules. I know this is a busy time of the year with graduations and warm weather and vacation plans and all that stuff. So we do appreciate you attending tonight's class. This is our second of four installments that we do with the UCR Alumni Association in helping educate our local communities on homeownership. Really excited to get a chance to spend some time with us. Tonight's class is going to be recorded, so we'll have tonight's class up on our YouTube channel tomorrow. We're also going to send out all of the presentation material slides from tonight's discussion as well. And this is a very interactive session. So as I go through tonight's content, really encourage you to ask questions. You can use both the chat or the Q&A feature within Zoom, and I'll go ahead and get those questions answered for you on air. And I do appreciate you spending some time with us on a busy week. So let's go ahead and dive in. And by the way, our run time for tonight's class will take us just about to the top of the hour. So we'll weave in some of your questions as we go through this content. Make sure we get all your questions answered. A little bit about me. Again, my name is Jason Maida. I'll be your host this evening, and I get a chance to partner with our local communities in home ownership. In fact, we've got a chance to help some of your fellow alum in the UCR Alumni Association earn home ownership. It's been back this year. We've held probably 2 or 3 of your classmates in home ownership, and look forward to doing more this year in 2025 and beyond. But I work for an organization called American Pacific Mortgage. We're the 9th largest lender in the country. We're based out of California, but we serve our communities all across the country. Our particular team, we specialize in educational first-time home buying. So we do that through our partnerships that we have spread out all over across the country. Like the UC Riverside Alumni Partnership, we have 15 other partnerships that we work with just to help serve our communities in affordable home ownership. So in our class tonight, like I said, it's going to be a very interactive session. We have some talking points for tonight's class, where we're going to spend some time looking at the housing market, kind of what's going on abroad in the housing market, what's happening with the interest rate world. I think some encouraging signs from an interest rate perspective. We are going to go through a rent versus buying exercise, where we're going to look at what does it look like today if I decide to continue renting versus what I think it could look like if I decide to purchase a home at some point in time. We'll also spend some time kind of getting our credit in shape. So understanding a little bit more about credit, some of the modeling for credit, and how to prepare ourselves for home ownership. We'll also talk about loan programs that are available to you as a prospective buyer, some of the product terminology that you've probably heard in the past, but we'll kind of bring that all together for you tonight. And then we'll talk a little bit about savings for home ownership. That tends to be one of the challenges or areas of opportunity for most first-time buyers. How do we save for home ownership? So we're going to walk through that. We'll also talk a little bit about first-time home buyers. I think most of our class is based out of California. So we'll spend a little bit of time tonight talking about the CalHFA first-time homebuyer program. And I also want to share with you a little bit about the buying process. So after tonight's class, you kind of want to figure out, like, where do I go from here? I've got all this great, useful information. How do I implement that into a plan for me in home ownership? And we'll take you through what a home buying plan and consultation looks like for us as we kind of talk through the workflow of buying a house. Okay, so that's our plan for tonight. Again, our run time for tonight's class will be just about an hour, maybe a little bit less. We'll make sure that we get all your questions attended to as we go through tonight's discussion. Well, let's talk a little bit about home buying, and really, does it make sense for me? This is probably going to be one of the biggest financial decisions you decide to make, and obviously, this is a Thursday night on a spring evening, so you probably have other things you'd rather be doing than listening to more about home ownership. But obviously, it's an important goal for many people across the country. When we think about home ownership, there's a few things that come along with it. One is I can create better stability in my housing expense. So I don't have to worry about my rent going up every year that I decide to renew my rent, or maybe, I've heard stories, my landlord's selling my house and now I'm kind of getting evicted, so I have to find somewhere else. You have more control as a homeowner. Now, today's rates are higher than, it has been historically, but many of our buyers that are purchasing in today's market are probably going to refinance in a couple years when rates start to normalize. And you as a future homeowner will have that same opportunity. And this is an asset that grows over time. So as I look at my home value, it goes up over time and obviously can go down at some point. But ultimately, real estate generally will go up as I pay down the balance on my home, the difference between what my market value is versus what my mortgage balance is called home equity. For most of us across the country, that's our number one asset that we have, and it can have the opportunity to create generational wealth for families. There's also some tax benefits that come along with owning a home. So potential tax deductibility of mortgage interest, as well as some tax benefits that come along with energy efficient upgrades to your home. So a lot of great things to consider with home ownership. To frame this all up from a budgeting perspective, I do want to walk us through a rent versus buying exercise, because when we think about comparing our budget for home ownership versus doing what I'm doing right now as renting, it's hard to kind of put together the ingredients or benefits of home ownership into my monthly budget. So oftentimes when I meet with clients, they may say, hey, I'm pretty good at $2,000 a month in rent. I probably shouldn't spend more than $2,000 in mortgage. And that might be the case for many clients we work with. But when we factor in the benefits like tax deductibility, appreciation benefits, control of my monthly expenses when I own my home versus renting, it could change the budget outlook for us. And so let's take a look at this rent versus buying calculator. I know some of you are joining late, which is totally fine. We're walking now through our rent versus buying calculator. Part of our interactive session is to kind of take you through this calculation. In case you guys missed it, we're going to send out all the presentation material to you tomorrow, so you'll be able to check this out and run your own calculations. So let me kind of walk you through this and what this exercise can show us. So the first kind of tab here is our renting tab, which ultimately is, what am I paying on a rental basis, right? So we have, for this particular scenario, $3,000 a month. We have monthly renter's insurance, and then we have the expectancy that our rent will increase 3% on an annualized basis. Okay, so that's where we land today in rent. Now, from a home purchase perspective, let's say we bought a $650,000 home. We put down a minimum of 3% down payment. Our taxes estimated are around $7,000 a month. Taxes will vary based upon where we're going to purchase in the state or the country. Those tax rates can change a little bit. We have homeowners insurance costs that obviously many of you in tonight's class probably have heard about, kind of some of the astronomical cost of homeowners insurance. That will change based upon where you're at in California, especially. So if you're in a high fire zone, insurance can look a lot different for someone, say, that's not in a fire zone, that's in more of a lesser brushed area, right? We have maintenance costs in our home, which we kind of built at $3,000 a month. We also have loan information, which is going to be an important component of our budget, right? So in this scenario, we say, okay, we're going to have a 30-year fixed mortgage that we're going to analyze. We have an average interest rate of just about 6.75%. And then when we take out financing to purchase our home, we do have origination costs. Now, one of your added benefits with the UC Riverside Alumni Association is that we discount our origination charges by $750 to create just better affordability for our future first-time buyers. Now, there's also discount points that come along with financing a home. That is an optional item for buyers where I can pay additional funds out of pocket in order to bring down my interest rate. So usually when I pay 1% of my loan amount, it will bring down my interest rate about 0.25%. Now, most clients that are buying in today's market, I don't recommend paying points because the return on investment is about 3 to 4 years for most scenarios. So it's highly likely that our clients that are buying in today's market are probably going to refinance in a couple of years. So we don't really want to make investments necessarily like that. And then we have other settlement services. When we think about that, we're talking about closing costs, title, escrow fees, maybe some of the transfer taxes for your respective county. So all of that will be lumped into this kind of other settlement services section. Let me grab a quick sip of water. All right. So last section in this calculator is other assumptions. We're going to assume that our home is going to appreciate about 4% on an annualized basis. Now that can change based upon where I'm going to purchase in the country or in the state. We have expected years in the home at 7 years. We have selling costs of my home. So eventually at the end of 7 years, what is it going to cost for me to sell my home? And then we have state and federal tax rate as well as a savings rate. So we kind of plug this into our calculation. We first of all want to take a look at payments, right? So, we know our rent payment's about $3,000. Now, if we compare that to home ownership, I'm going to have to elevate my cost. If I'm going to buy a $650,000 home, that would put my monthly payment at around $5,600 from a housing perspective as a owner, right? Now, while I'm going to be elevating my outgoing expense as a future home buyer, Where we have to kind of dig a little bit deeper is what's my cost opportunity over the next 7 years. In fact, by owning versus renting over the next 7 years, I'm actually going to save myself $66,000. Now, the way we get there is by assuming appreciation rates like we looked at 4%, and we also assess tax deductibility opportunities by owning versus renting. So what I would encourage our class is that as you're considering home ownership, it's not necessarily that apples to apples comparison of your rent budget versus a home ownership budget. Everybody's situation is going to be a little bit different, but I would encourage you to take a peek at that calculator. I think it really can kind of open the perspective up of what home ownership could look like for you. All right. Now, as we consider home buying and making this major financial decision, we have to assess what the housing market is doing, right? Now, we're going to spend some time looking at the Riverside housing market just because we're teaching a class for UC Riverside. Certainly, we can have some discussions around other markets, what they look like. Let me give you kind of just a macro view of what the housing market looks like right now. We're currently in most markets seeing inventory starting to stack up a little bit. So, that's one of our bigger challenges that we've had all across the country for the last 2 or 3 years, just not enough supply to support buyer demand. But we're starting to see more inventory come online. Part of it's seasonality. Part of it's just because sellers are now needing to sell. And usually the Memorial Day weekend, 3-day weekend, brings more sellers to market. In fact, we're seeing that. California has some higher inventory levels in other parts of the country higher cities with higher inventory levels than others in California. The four highest year-over-year inventory levels in California include Sacramento, San Jose, Los Angeles. I think there's one other, maybe it's only 3 that are included in that, but we are seeing inventory levels pick up year over year. Now, Riverside is one of those counties that we do see a lot of our maybe intended LA purchasing buyers start to migrate to more of Riverside. We also see that in Northern California with a lot of Bay Area buyers maybe moving to more of a lesser cost of living market like Sacramento. So I would look at Riverside and San Bernardino, very similar in those type of communities. You can see if we look at the data points, median sales price is kind of just bumping around 650, 44 days on market, which is higher than we've seen year over year. So stuff is starting to stay a little bit longer. And I think that's important for you to understand as buyers, because I do see a little bit of a pivot in this market where we could see this be more of a buyer's market. And honestly, we haven't seen that in several years across California and other markets across the country. So where sellers are being a little bit more flexible in their price, we've seen seller concessions on 44% of all transactions. So that means our sellers are conceding credits towards buyers' closing costs on almost half of all transactions being done across the country. So I think things are looking up for buyers. Now, interest rates aren't in a optimal level, certainly, but I think for those that are financially fit and ready to pursue homeownership, there are certainly some opportunities out there in today's market. As we look at today's interest rates remain at elevated levels. We're right around 6.8, give or take the day. This kind of shows you what the last 12 months of interest rates have looked like. We've kind of bounced around between the lowest levels, which were about 6.375, highest levels, right, pushing against that 7% level. So we've kind of had this bumpy path when it comes to interest rates. Most recently, in the last couple of days, we've had some encouraging signs of maybe future trends down in interest rates. We had some inflation data come in that was a little bit less than expected. If you guys are paying attention to what's going on in the global economy or in the U.S. economy, the Federal Reserve has ratcheted up interest rates to combat inflation. And the Federal Reserve has a mandate of a 2% inflation level and then stable labor markets to make decisions on cutting interest rates. And so when we see cooling of inflation, that could lead to potential future rate cuts by the Federal Reserve. Not going to happen probably in the month of June at their next meeting, but maybe future meetings we could see that. So we're obviously watching interest rates really carefully for clients. Ultimately, as some clients decide to pursue today's market, we will be buying at higher interest rate levels, but there will be an opportunity in the next couple of years to potentially refinance as rates decline lower. Now, the interest rates in today's market don't look a lot different than what we saw 20 years ago. Now, the home prices 20 years ago were a fraction of what they are today, but these markets and interest rates will cycle. And I think for those of us that were really paying a lot of attention of what was going on with interest rates back in 2020, 2021, we saw interest rates down at 2.5% levels. I get the question often is, are we going to have a repeat of those interest rates at some point in time? Highly unlikely because, if we do see interest rates at that level, that means something really catastrophic has happened globally. So obviously we don't want to return to what we had in the pandemic state. But ultimately, interest rates will flux over time. Have the average kind of historical rate puts us in the high fours to low fives is kind of what we see as more of a historical average. Now, all interest rates are not the same for every buyer, so that's important to understand as well. Different characteristics make up interest rate, like credit score and overall eligibility, the type of program I'm going to do, how much I decide to finance, what my down payment looks like. We spent a few minutes talking a little bit about discount points, so I can choose as a consumer to bring down my interest rate by paying more out of pocket. And then the term of my loan can also impact what my interest rate might look like. So traditionally, most buyers will elect a 30-year fixed mortgage, but if I shrink that down to 15 or 20 years, that can also give me the ability to bring down my interest rate. Ultimately, as we meet with you to design your own customized home buying plan, we're going to figure out the right product structure for you and obviously the corresponding interest rate. Interest rates change daily based upon what's going on in the financial markets. So when the financial markets open up, interest rates will move every minute, right? And so it's our job as your lender to help kind of chart that for you to hopefully seize the lowest opportunity as we kind of go through your home buying scenario. Right now, interest rates generally don't get locked in for a consumer until we're under contract with a seller. Now, one of the major things that can influence my interest rate is where I'm at in credit. Now, am I prepared for home ownership? Where does my credit currently look like? Every loan program has a minimum credit score. We put some of those programs on screen here. We're going to spend some time looking at loan programs this evening to get a better idea of some of the characteristics. But as we have the ability to bring up our credit score, ultimately the lesser cost I'm going to see from a financing perspective. Now, when we look at the credit scores, there are three of them, as many of you all know, right? There's three different agencies. There's Experian, Equifax, and TransUnion. Each one reports a different score. In lending, we always look at the middle credit score of those three agencies reporting. So if my highest score is 760, my middle score is 740, and my lowest is 720, we're going to use 740 for the credit score to calculate our eligibility for financing. Now, if I decide to add my partner to my loan application, but let's say my partner's credit scores are slightly lower, maybe they're at 700, 680, and 640. Well, that 680 is the lowest middle score between both of us. So that's what would be used from a qualifying perspective. All right. Now, there are three different models to scoring. There's the credit card model, there's auto financing, and then there's the mortgage model. Now, for those of you that are using things like Credit Karma or any type of monitoring tools that you're using to subscribe to, they're generally going to be using the credit card model. So oftentimes when I meet with clients, they say, hey, Jason, Credit Karma shows me at 760, but your score is 755. The difference is because we're looking at kind of different models. Now, tonight, we're going to spend some time looking at the mortgage model so you can maybe understand some areas of opportunity that you can uncover to help elevate your credit score. Now, generally, when I've had past challenges, like let's say a late payment or I was over limit on a card, whatever the case may be, usually that's going to impact my credit score for the most recent 12 to 24 months from the date of the event. Now, the impression of that delinquent item or whatever the event might be will stay longer, and this matrix kind of highlights that, but ultimately the effect on my credit score is in the most recent 12 to 24 months. Now, this is what the mortgage credit model looks like, and so I want to walk through each area of the model for you so you can have a better understanding of it. So as you assess your own personal credit score, there might be an area of opportunity to help you lift your score. Now, the first component of the weighting is the length of credit. So how long have I had credit? So the longer my credit file has been open, probably the higher my credit score is going to be, right? Now, if I've had credit for 6 years, as opposed to someone that's had credit for 6 months, the person that has a 6-year credit history is probably going to have a higher credit score. Just depends on kind of like the dynamic of their score and what accounts they have opened, right? So the next weighting is the new accounts that I'm trying to open, which is 20%. So if I'm opening a lot of new accounts, especially in the most recent 6 to 12 months, I'm probably going to see some pullback in my credit score as opposed to someone that's really not opening a lot of new accounts. And the other thing we're looking at in this segment is we're also looking at inquiries that you do on your credit. So we really want to avoid multiple inquiries. especially as we're looking at department stores, or maybe we're shopping for cars, whatever the case may be, especially in the most recent 6 to 12 months, right? Now, there are credit rules in place that state that I can shop around with a auto finance lender within a 30-day period of time, and that's the equivalent of 1 credit inquiry hit to my score. That rule still holds true also for mortgage as well. Now, one of the benefits that we have in working with us is that we only start with a soft credit check when it comes to building your financing plan, because for many of our first-time buyers, this buying process could take multiple months. It could take several years. And so we want to provide you a game plan for homeownership without impacting your credit score. So we always start with a soft credit check. Next component is how much do I owe in revolving credit card debt? We also call that credit utilization. We're simply looking at the outstanding credit limits I have on my credit cards versus what my balances are. Now, so as an example, if I have $10,000 in limits and my balances are $5,000, I'm at 50% utilization of credit today. Now, if I've recently added more charges to my credit cards and now they're pushed up to like $8,000 in balances, now, of course, I'm at 80% utilization. The rule of thumb is that we want to first, if we're at 80% utilization, try to work our way down to 50% utilization. Once we've got to that level of credit card debt, then we want to get down to 30% utilization. And then the optimal level is 10% utilization of credit. So that's kind of where we want to go with managing our credit card debt. Now, as you look at your credit cards, I want to point out an important feature. There's 2 dates to your credit card statements. One is your billing cycle date. The other is your due date. The date on the billing cycle date is when all your activity from the previous 30 days gets closed out, and now the credit card issuer reports all the information to the credit agencies, like what your credit limit is, what your balance is, how you paid your bills, all that fun stuff, right? So what I would encourage our class to do is, if you can try and pay down your accounts before the end of the billing cycle date, you're going to do a couple things. One is you're going to bring down your utilization of credit. You're going to bring down your monthly payment that you have on that credit card. But more importantly is, as you increase your availability in those credit cards, you lift your credit score. And you're able to do that by paying those before the billing cycle date, because that picks up the accounts before the reporting comes out to the bureaus. Last thing is payment history, which is pretty simple, right? So how have I paid my bills? If I've had any late payments, those are rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. So the more severe I'm on that spectrum of lates, the bigger impact I'm going to have to my credit score. However, we're really looking at the last 12 to 24 months in terms of how it really impacts our credit score. All right, I'm going to take a quick pause there. Any questions about credit or some of the content we've covered so far? All right, and you can always use the chat or the Q&A feature, and I'll go ahead and get those questions retrieved here for you. We can answer those on air. We're going to kind of stick with credit just a little bit longer and talk a little bit about student loans, because ultimately those appear on your credit report. Now, we're seeing a lot of federal student debt that's actually going back into repayment. Some of you in tonight's class that do have student loan debt might be in deferment. You might be in forbearance. But ultimately, if you are in one of those categories of forbearance or deferment, we do have to count a minimum payment against you for qualifying for your home financing. So if you're in repayment and you're on an income-based repayment plan, let's say you owe $75,000 in student loan debt and your monthly payment is set at $250 per month and you're paying that amount, that's the amount that we're going to use from a qualifying perspective. But many of us have been in forbearance for the last couple of years, and some might be coming back online with payments. If you're not currently actively paying payments on your student loans, then if we're qualifying for, say, an FHA loan, which is a Federal Housing Administration loan, we use 0.5% of the outstanding balances to assess a monthly payment. For a conventional loan, we use 1% of the total balances to assess the payment. So that can be really important as we design our home buying options for our clients, because we always assess expenses versus income. So, many of our clients right now are coming back online with monthly payments, and so it makes the calculation a lot easier. Generally speaking, if you have an income-based repayment option, that's going to be the lowest option, which certainly will help when it comes to qualifying for your home financing. Now, when we look at student loans, the reason why we're assessing that is because each program has a guideline that addresses student loans and other types of debt. So tonight we're going to talk a little bit about different loan programs that are available to you. You may have heard of these terms before, pretty commonplace stuff, but we want to examine some of the characteristics of each one of these products. We'll start with the conventional loan first, which is a Fannie Mae and Freddie Mac loan. You may have heard of that terminology. Fannie Mae and Freddie Mac is getting some talk right now in the political arena because they're talking about maybe taking Fannie Mae and Freddie Mac out of really conservatorship from the U.S. Government and making them more kind of privatized. And so we'll see kind of what that happens. But ultimately, Fannie and Freddie have their own set of guidelines. As a first-time buyer, you have a minimum down payment of 3% up to a loan amount of $806,500 in all of the counties across the country, for that matter. Minimum credit score of 620. Now, if you're in the LA market or Orange County, San Diego, Ventura County, wherever, there are higher limits that we can go to because those are considered high balance areas. San Bernardino County and Riverside County maximum loan amount is $806,500, but you can go up to $1,200,000 in LA County, but it does change the minimum down payment from 3% to 5%. Next product is an FHA loan. That is a government insured loan. FHA, as I mentioned just a little while ago, stands for the Federal Housing Administration. Now, I want to point out an important update. So last month, there was updates made by the administration on both the FHA loan and the USDA loan. Those are both government insured loans. So to be eligible for those products, you do have to be a permanent resident to access those programs. Unfortunately, only non-residents can now participate in a conventional loan. So that was a guideline change made last month that is now in effect. So I just want to make sure that we highlight that for our class. The minimum down payment for an FHA loan is 3.5% of the sales price, minimum credit score of 580. And then the loan amount does vary by county. There's a lot more flexibility in the FHA guidelines than what we'd probably see with a conventional loan. So if I had maybe a late payment on a student loan just last October, it might be a little bit more challenging to qualify on a conventional loan because I've had my impact on my credit score and my report versus FHA would probably be a little bit more flexible with that. The jumbo loan has an option for clients that need a little bit more bandwidth in their financing availability, but it does come with it higher down payment requirements of 10 to 15% down, usually higher credit score requirements as well. The VA home loan that's for veterans that have eligibility under that product. It is a zero down payment option, minimum credit score of 620, and there really is no maximum loan amount. In fact, we'll fund up to $5 million as a zero down payment option for veterans. For the VA home loan product, if a veteran has any partial disability up 10% or more, then they have a funding fee that is waived, because generally for veterans that participate in this program, there is a upfront funding fee of 2.3% of the loan amount for first-time users. And then the USDA product, again, mentioned some guideline changes as of May, but ultimately the USDA product allows buyers to purchase in more rural areas. So let's say you really want to buy a home in Joshua Tree. More than likely, Joshua Tree is going to qualify under USDA. The benefit there is a zero down payment option, but there's also income qualifying requirements by the size of your household. All right. USDA will look very similar to FHA in terms of how we follow the loan amounts, but the two big qualifiers under USDA are going to be income and then location of the property. Now, one of the things that comes up in our conversations with clients is if I'm putting less than 20% down, what does that mean for me? What's PMI, right? Well, PMI stands for private mortgage insurance. And as we look at both the conventional loan and the FHA loan, there's two kind of ways that we kind of set up mortgage insurance, if you will. Now, what does mortgage insurance do? It's not homeowners insurance. It's actually mortgage insurance that insures the lender against default by the buyer. So if there was an economic hardship and the buyer had some challenges, then the lender would be protected against that default by the buyer. Now, on a conventional loan, mortgage insurance is going to be based upon, the premium will be based upon what my down payment looks like, how much I decide to finance, and then what my credit score is. One of the benefits of a conventional loan is that once I reach 2 years in that loan and I achieve 22% equity, then I can apply to have my mortgage insurance canceled. And so if you've started your home search maybe on Redfin or Zillow already, which that happens quite often in our classes, you'll notice on some of their calculating features that the calculators generally have a higher mortgage insurance premium. And so if you looked at on our example here on screen, we financed $450,000 with a 740 credit score and putting 3% down. Mortgage insurance is about $183 a month. So many of you that maybe have started using some calculators online, that mortgage insurance probably looks a lot higher because it's not calibrated to the characteristics that actually make up mortgage insurance. On the FHA side of it, there's two forms of mortgage insurance. There's monthly mortgage insurance, which is 0.55% of the total loan amount. And then there's upfront mortgage insurance that gets added into my total amount financed. Now, Different from a conventional loan, FHA's mortgage insurance does not have a cancellation option. So we generally use the FHA product to get entry to homeownership for some of our clients, especially if we have credit challenges or whatnot. And then ultimately, as our clients improve credit, as their financial state changes for the better, then we're going to look to try to transition through a refinance into a conventional loan. Now, here's an example of the FHA mortgage insurance premium, same loan amount of $450. We have the upfront mortgage insurance that gets added in for $78.75, and then the monthly mortgage insurance of $206 per month. So that's kind of what that will look like on the FHA side of it. Ultimately, as we design options for our clients, we're going to figure out which product makes the most sense for our clients based upon their eligibility and ultimately their financial objectives in home ownership. But there truly is different options that are available to clients. Now, one of the things that we'll assess as we build a plan for our client is taking a look at our income, right? And there's various things that we have to validate in income. I provide you with a general documentation of what documents we generally ask for in the process, right? But I think there's also important things to understand from an employment perspective because we get a lot of questions around income from future clients. One is that many clients think that they have to be on their job several years to be able to qualify for a mortgage, which isn't really the case. So in lending, we always have to verify a 2-year work and or education history. So I like to use this example for our classes, which is, if I just graduated from UC Riverside in the fall and I've started my new job January 1, I can still qualify for a mortgage as long as I can show a total combined of 2 years history at UCR or on the job that with my current employer, right? So that can fulfill the requirement of 2 years. We even have scenarios too where clients are transitioning jobs. Let's say I've been at my job here for the last 10 years, and now I'm going to get hired on with the state, and I'm going to start my job next month. Well, with my new offer letter that I have for my prospective job, I can actually qualify for a mortgage right there with that offer letter. Now, where the timelines get a little bit more tricky, I guess, if you will, is for self-employed clients. Self-employed clients do have to have a 2-year tax filing. So if I'm self-employed today, I have to verify the last 2 years of taxes, 24 and 23. If I also have multiple jobs, let's say I have 2 part-time jobs and I want to count both sources, I have to show that I've been on both jobs simultaneously for the last 2 years in order to count that income. Also, if I have bonuses or overtime, things that can kind of vary based upon what I do with my job, right? In that case, I generally have to show that I've been on my job 2 years in order to count those variable sources. Last thing I want to touch on in income, and we're going to talk about expenses versus income, is looking at other sources of income. So if I have a roommate that's contributing to my household, I can't generally use that income for qualifying. And if I have a partner that also contributes to our household expenses, but is choosing not to be on the application, then I can't include that income from a qualifying perspective, okay? So that's kind of what we look at from an income perspective. Now, we also look at expenses versus income, and we call that calculation debt to income ratio. It's a really simple equation, but it looks at your existing expenses like personal loans, credit cards, auto financing, student loans. We also factor in housing expense, like the principal and interest of my loan, what my property taxes look like for my house, homeowner's insurance, maybe I'm paying mortgage insurance. And we take that versus our pre-tax income. So we've provided kind of an example here for you on screen of what that could look like for a prospective client. But if we had somebody that's paying $2,500 in housing expense, they have $500 in outgoing debts, and they're making $8,500 a month. So right now we have $3,000 in expenses versus $8,500. So that client's debt to income ratio is 35.3%. Now, the question I get from clients as I work with them on their plans is, where should that number be? Well, I would say excellent is less than 36%. So maybe 33 to 36%. We can go as high as 50%. That's the maximum, but obviously we get a little bit of concern there because we want to make sure we create affordable and sustainable home ownership for our clients. And obviously if we're pushing that budget, hopefully there's other sources of income within the household that we can't maybe validate that's going to allow that payment to be a little easier for our clients. But that's a calculation that we look at to determine eligibility. But again, it's not an affordable calculation. So the conversation we're going to have during a consultation with you is to figure out really what does affordability look like for me. Last topic I want to share with you guys tonight before we talk about the workflow of buying a house is down payment. And that's probably one of the bigger challenges to homeownership for most clients that I get a chance to work with in building their plans, is just because we can't save up enough, maybe because the cost of living is just too much, or I have some student loan debt that's kind of tying me down right now, or I'm new on my job. A lot of those things play in these factors. Now, as we continue to get financially fit for homeownership, we have to think about, the savings that we have right now. Can that work for me in homeownership? There are sources that we can use for qualifying for mortgages, like, last 60 days of bank records that we can validate what's in your checking and savings account if you have enough saved for homeownership. Retirement accounts can be potentially used. We would always encourage you, before you use retirement or investment brokerage accounts, talk to your financial or tax advisor. Make sure you're not creating a tax event for yourself. Gift funds can also be used in homeownership, and there really is no minimum contribution by the buyer. A family member can help you with all of your funds needed to home purchase. We just have to document how those funds come to you from the donor. Generally, in financing and buying a home, we have to have 60 days of seasoned assets. However, gift funds can be used right away in a home purchase transaction. Now, one of the things I like to share with our classes that we teach is that a really simple approach to savings, and I know that's probably easier said than done for most of us, but ultimately, as we think about preparing for home ownership and what our monthly budget can be, our simple approach is to look at it like this. If I'm paying, let's say, $2,000 a month in rent, but after consulting with us for your home buying plan, we feel like I can hit a budget of $3,500, but maybe I'm just lacking the savings right now to pursue home ownership. And, of course, assistance programs, which we'll talk about in just a minute, will help you. But what I would encourage the client to do is, let's start saving like we're making that $3,500 mortgage payment today. So on the 1st of July, when I pay that $2,000 to my landlord, create the habit or discipline that I'm going to take that extra $1,500 that I ultimately would probably put into a mortgage. Let's transfer that into our savings account. And as we do that, we create that rhythm or habit of like getting in the habit of making a mortgage payment, right? So it's not such a big payment shock to us, but we're also growing savings over time, right? So in 6 months, I have $9,000 saved. Over the course of a year, I have $18,000 saved. And that is a great way to start saving towards home ownership. I do understand it's easier said than done at times, but if you make that little subtle adjustment, maybe it's not $1,500 in savings, maybe it's $500. But even with compounding or high yield interest accounts, that can really stack up over time. Now, for some of us, the savings challenge might be, a little bit more difficult for us, but there are assistance programs all across the country to help low to moderate income housing buyers in homeownership. I do think most of our classes here in California, so I want to spend some time talking about the California Housing Finance Agency. We're pleasure to be the #1 partner of CalHFA across the state. I get a chance to work with buyers from San Diego to Eureka, all across California, in designing home buying plans. And there's some really great resources available to you as low to moderate income households. So the first product I want to spotlight is the MyHome product, which provides up to 3% of your sales price in assistance on a conventional loan. If you go an FHA product, it's 3.5%. Ultimately, what that is, it's a simple 1% interest rate loan that the state provides to you that's separate from your mortgage and allows you to fulfill your minimum down payment as a first-time buyer to purchase in California. So when we think about home ownership, if we can get our down payments supplemented, then all we would have basically is closing costs out of pocket. Well, there's also other programs to help you with that, like the My Access program, which provides up to 2.5% of your loan amount in additional assistance. That's a 1% simple interest rate loan, also deferred payment, not required to be paid back until you sell or refinance in the future. And then there's the ZIP Assistance program. The My Access and the ZIP Assistance are kind of interchangeable programs. Depends on how the first mortgage rate looks that day. But the ZIP program provides 2% of the loan amount, so a little bit lower than the My Access program, but it's at a 0% interest, also not repaying until you sell or refinance in the future. Now, some of you may have kind of heard about CalHFA because of the Dream for All program that we've funded the last couple of years. There currently is not a funding mechanism for Dream for All. That may come back online next year, but it's not currently part of the state's budget. We had the pleasure of helping build that program a few years ago with CalHFA. Really proud of our work there, but right now we don't have any funding currently with the state on that program. We'll see if it comes back online in the next year or so. Other programs available like the Pathway DPA programs, another assistance program, provides up to 3.5% to 5% of your loan amount in assistance. You also may have heard about the GSFA program in California. That's called the Golden State Finance Authority product. That's usually kind of a second tier option for clients that don't qualify in CalHFA. But GSFA does allow clients to purchase 2-unit properties with their product line versus CalHFA, it can only be a 1-unit property. I just want to show you a quick example of how CalHFA can help substitute some of the resources needed. So this is just kind of a traditional example of buying a $450,000 home, right? We would generally need $13,500 for down payment, plus closing costs of $9,000 to $13,000. So, if I was a client purchasing without first-time buyer resources, I probably need to save up about $22,000 to $27,000 realistically, right? Now, if I use a first-time buyer program, now I have the benefit of the My Home assistance to substitute my down payment, and I can also participate in closing cost assistance. So, someone that's a first-time buyer has the opportunity to create upwards of $24,000 in assistance for them and really close the gap in terms of what resources are needed in order to help them purchase a home. So it's an awesome product available for us in California. Now, there are some eligibility requirements: minimum credit score of 640 for an FHA loan, 680 for the conventional product. We spent some time talking about debt to income ratio. So generally, we can't go higher than 50% or 45 to 50%. The income qualifications on this program is a lot more lenient than most first-time buyer programs. We can go all the way up to 150% of the median income for your county. And we only look at income for the applicants. And so what that would look like is that if I'm going to buy in LA County where the income limits are $194,000, let's say I make $150,000 and my partner makes $100,000. I could apply in just my name with my $150,000 income. And if I can qualify for a home, that's the only income considered for the first-time buyer program. So just a lot more flexibility there. Now, a first-time buyer is someone that hasn't owned in the last 3 years. So I could have bought in 2010, sold my home. I can now become a first-time buyer again. And this is only eligible for 1-unit properties like single-family homes. You can buy new construction, that's completely allowed, condos, townhouses, even below-market homes, and manufactured homes that are on permanent foundation. This is the income limits for the greater Southern California market, so you guys can see that on screen. We'll put in the chat the link to the CalHFA income limit page. So if you're not in the Southern California markets, maybe you're in Northern California or the Central Coast, wherever you're at, there's income limits for each county. And I would encourage you to really take a look at CalHFA. We do have some helpful tutorial videos specifically on CalHFA on our YouTube channel. You just might want to check out. We've kind of spotlighted every one of those programs. And I think it's a great tool just to help you understand a little bit more about what your resources look like as a first-time buyer in California. Well, last thing I want to talk a little bit about is the buying process. Like, where do I go from here after attending tonight's class? Well, we hope you get a chance to connect with us for a consultation. I spend my days, if I'm not teaching, working one-on-one with clients and designing their home buying plans. And so that usually is kind of the next step after tonight's class. Now, when we meet with you for a consultation, you'll have the option to be able to be pre-approved for your home purchase. That pre-approval allows you to be able to start going out and being active in the market and making offers. That pre-approval is usually good for 60 days, but we can always recertify that at any time. We're ultimately going to tailor that pre-approval to your budget and what your eligibility looks like. That then moves us to step 2, which is the house hunting phase in the buying process. It'll generally start online and then transition to in person. We encourage you to connect with a local realtor. A realtor should be an expert in their communities, understand like how to negotiate contracts, have some really great partners that they work with for inspections. We have a preferred realtor network that we can introduce you to one of our partners whenever that time comes. So, but step 2 is kind of the house hunting phase. Now, that can take generally the longest phase in the process. A lot of people ask me, well, Jason, how long is it going to take me to buy a house, right? I think it really just depends on where you want to buy. And if you have a specific location and design of home, it could take a little bit longer. But on average, for clients that are actively shopping, I would say it takes about 3 to 6 months. Now, let's say I find a home that I really like and I want to make an offer on that home, and I present an offer to a seller through my realtor. That offer gets accepted. Now we're going to move to step 3, which is basically entering escrow in California. What that means is you've ratified a contract with you and the seller. And that generally happens 2 or 3 times a day with our team. And at that time, when that comes, I give our clients a call and say, hey, congratulations. The heavy lifting's kind of done. You found the right house. Let's put together your financing and kind of walk through what the process is now going to look like. That follow-up consultation that we're going to now do with you includes reviewing your payments, make sure that budget is in line with what you expected, what your out-of-pocket expense looks like, what are the expenses you've agreed to pay as part of the seller contract. All that stuff happens in a follow-up consultation. Now, you will start to have action items come across your desk, so to speak, as a first-time buyer. You're going to have to make an earnest money deposit, which is usually 1 to 2% of your purchase price. Your inspection periods will begin. We'll also start working on things like your appraisal and your loan approval. All those things will start taking shape as you begin the process. Now, this is a slide that kind of highlights what an earnest money deposit does. It ultimately shows the seller that you have a financial stake in the success of this home purchase. Those monies are protected by what we call the contingency period, which inside your real estate contract, most contracts close in 30 days, but it can be as short as 14 days. But inside that 30-day window will be contingency timelines that allow you to do your investigative work or research on the house. That'll include an appraisal of the property to make sure the value supports your purchase price, make sure your inspections check out fine, and then you want to get your loan approved. I'll, of course, work on the appraisal and the loan side of things, and then your realtor will work on the inspection side of it. Now, as we move across these milestones, you have kind of more of the administrative functions like the processing and the underwriting of your loan, which ultimately means like verifying assets and income and make sure your product type is all set up properly. All that happens in step 4. We continue to move along with step 5, which is the loan approval phase. That comes after we've done all the kind of the research work for your financing. That loan approval comes from an underwriter that indicates that everything checks out. Credit's great, income is fine, the product solution works, and you have the assets to close. So that all happens at step 5. Now, as we go through that step 3 to step 6, we're looking at what's going on with interest rates too, because as I mentioned earlier, interest rates change throughout the course of the business day. And ultimately, we're trying to watch and survey the market to lock in the lowest available rate that we can offer to you as a client. But we're going to talk a little bit about that during your follow-up consultation. Now, step 5 also brings us to the end of the contingency period. So if you've done all your due diligence, you feel good with the outcome of your investigative reports, you have your appraisal done, your loan approval, then you're going to sign off on your contingencies. That tells the seller that you're ready to move to the final stages. Part of those final stages include us delivering a final closing disclosure to you, which ultimately gives you a 3-day cooling off period before you sign final loan documents with a public notary. Those documents are done in person. That's really the only thing that's done in person in this process, other than getting the keys to your house and walking around your house and making sure it's the right place. But everything is generally done electronically in the buying process with us. At the very end, we're going to fund your loan, which includes wiring in the funds for your financing and any assistance programs. You also wire in your funds for any remaining cash contribution that you have to make. Those funds get settled up with an escrow team, and then documents get recorded with a county recorder's office. They generally record a grant deed, which is going to be the transfer document to you, the new owners, and then the deed for the loan, which is, of course, your repayment plans for the loan. Now, after we get the confirmation of that, then the best part of my day comes is because I get to call you and say, hey, congratulations, you're now a new homeowner. Best part of my day, bar none. Tomorrow, I think we have 4 or 5 clients that are going to be getting their keys to their homes. It's just a really cool thing to be able to experience with our clients, because it is, again, going to be one of the biggest financial decisions you guys decide to make. Now, our relationships don't stop with our clients there, because part of our aftercare, we're watching rates to see when refinancing might make sense for you. We're tracking your home equity through our HomeBot system, and we're always staying connected with our clients at least on an annual basis just to see what's going on with you financially. All right, well, I got a few more minutes left, and I just want to kind of share with you again how you can get started in this process. So if you're interested in connecting with me for a consultation, it's a free service we provide to our local communities to help educate you on home ownership, taking the classwork to actually real time, like what does it look like to purchase a home. It's a 3-step process. It includes an online application. It's only a soft credit check, and then you'll upload documents and then use our scheduling system to schedule a consultation time that works good for you. So that's kind of what our process looks like now. If you have some follow-up questions after tonight's class, and I know we're going to spend some time answering some questions if there's any in the group, you can always schedule an introductory call, which we can hop on a phone conversation, just make sure that you get any questions that you have answered by myself or one of our team members. Here's what a free consultation looks like for you. So it's understanding more about budget, where do I want to buy, which first-time buyers programs could work best for me. Let's talk a little bit about interest rates and the kind of the interest rate climate as it relates to the kind of the product you're looking at. And we're going to kind of uncover also some credit opportunities. So all the things that you've learned in tonight's class, we're going to put them into kind of real action for you as part of your consultation. Now, last thing I want to share with you is our resources on the mobile. We believe in a high-touch experience, but we also leverage technology. So you can start this process via mobile. It'll also push notifications for you on the status of your application. You can also use the calculation feature within the mobile device. Again, just want to kind of spotlight our partnership with UCR alumni. Obviously, that's why you've heard about the science class. We do discount our services to help better support our local communities in home ownership and obviously help you participate in some of these first-time buyer resources that are available to you. I also have other classes that are offered through different partnerships across the country. So if you've enjoyed tonight's session, please feel free to share this with friends, family, coworkers. Most of our sessions we do across the calendar over the year, which will be about 60 plus classes. They're all free to the public. So feel free to share this with your friends and family and, like I said, coworkers. Here's all my contact information. So if you do have some questions that don't get answered tonight or just want to get connected with me for just ideas around home ownership or anything we can help with, feel free to message me here using my contact information. Again, tonight's class is being recorded, so we'll have that up on our YouTube channel. Feel free to access that, and we'll also have the slides available for you tomorrow morning. All right. Well, that brings me to the end of tonight's class. Thank you for the positive message in the chat there. I appreciate that. Any questions from our class that I can help with before we wrap up tonight's class? I know I'm finishing up a little bit earlier before the top of the hour, so I'm going to give you a few minutes back. But any questions from our group at all that I can help answer? Okay. Just make sure nobody's typing away. So I'll hang out just a second, make sure I'm not missing anything. Okay, I think we're good. Well, thank you so much for your time this evening. I hope you guys enjoy the rest of your weeks and hopefully get a chance to connect with you all soon to help you in your path towards homeownership. Have a wonderful night. Good night.